Ever wondered why stock markets often seem like a maze? Can understanding certain terms help us navigate it better? Let's dive in. Picture a bustling marketplace, but instead of fruits and vegetables, it's stocks and bonds on offer. That's the stock market, a complex world where every decision can lead to a thrilling victory or a crushing defeat. But what if we could simplify this complexity? Well, we can. By understanding key terms and measures, we can transform this bewildering labyrinth into a navigable landscape. Just as knowing the rules of the road makes driving easier, understanding the language of the stock market can empower us to make informed decisions and potentially avoid costly mistakes. So what are these key terms? They include exchanges, market cap, earnings date, price, index, and dividend yield, to name a few. Each term carries its own significance, and understanding them is like unlocking a secret code. For instance, knowing the market cap or the market capitalization of a company can give us insights into the company's size and stability. The earnings date can indicate when a company will report its profits, potentially affecting its stock price. But it's not just about understanding individual terms. It's about understanding how they interrelate and influence one another. For instance, the price of a stock isn't just a random number. It's influenced by a multitude of factors, including the company's earnings, its dividend yield, and even broader market trends. The takeaway here? Knowledge is power. The more we understand these terms, the better we can navigate the stock market. And while it might seem daunting, remember that every expert was once a beginner, so don't shy away from the challenge. Embrace it. And this is just the beginning. As we delve deeper into the world of finance, we'll unpack more terms, explore market movements, and strive to make sense of this complex but fascinating world. As we move forward, we'll break down these terms to help you understand the stock market better. First, let's understand the basics. What are exchanges, market cap, earnings date, price, and index? To start, exchanges are places where stocks are bought and sold. Think of it as a bustling marketplace where buyers and sellers come together to trade. Some of the most well-known exchanges include the New York Stock Exchange and the Nasdaq. Now, onto market capitalization, or market cap. This term refers to the total value of all a company's shares of stock. It's calculated by multiplying the company's share price by its total number of outstanding shares. This gives us an idea of the company's size and worth. Next up, earnings date. This is the day a company publicly discloses its profits or earnings for a specific period. It's a significant date, as investors closely watch these reports to assess the company's financial health. Price, in the stock market context, refers to the cost of a single share of a company's stock. It's determined by supply and demand dynamics in the market. A high demand for the stock pushes the price up, while a low demand brings it down. Lastly, we have the index. This is a tool that tracks the performance of a group of stocks, providing a snapshot of the market's overall health. Some popular indices include the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite. These terms play crucial roles in the stock market. Exchanges facilitate the trading process. Market cap provides a measure of a company's value. Earnings date offers insights into a company's profitability. Price reflects the market's valuation of a company. And index gauges the overall market performance. Understanding these terms is like learning the alphabet before writing sentences. It's the first step towards making sense of the complex world of stock markets. These terms lay the foundation for understanding stock market movements. Moving forward, let's delve into terms like dividend yield, average volume, target price, sector, and float short. Starting with dividend yield. This term refers to a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's a way to gauge the income-generating potential of a stock investment over time. So, if you're an investor looking for steady income, you'd want to pay attention to stocks with high dividend yields. Next, we have average volume. This is the number of shares traded in a security or an entire market during a given period. It's a measure of liquidity, meaning how easily you can buy or sell a stock without affecting its price. Higher average volume indicates more liquidity, which can translate to less risk because you can expect to buy or sell at your desired price point. Now, let's talk about target price. This is the projected future price of a stock, as estimated by an analyst or investor. It's a prediction, not a guarantee, but it can give you a sense of where the market expects a stock to go. Keep in mind, though, that predictions can be wrong, so always do your own research. The term sector refers to a segment of the economy. It's a way of categorizing companies based on their primary business activities. For example, you might hear about the technology sector, the healthcare sector, and so on. Investing in different sectors can help diversify your portfolio, spreading risk across various industries. Lastly, float short. This is the percentage of a company's publicly traded shares that are being shorted, meaning shares that investors have sold but not yet covered. It can give you a sense of market sentiment. A high float short suggests that many investors expect the stock's price to fall. Getting a grip on these terms will give you a sharper insight into the stock market's workings. Now, these are just a few of the many terms you'll need to understand to navigate the stock market. But don't worry, we'll continue to unpack more in the next scene. So, stay tuned. Now, let's explore terms like IPO date, industry, analyst recommendations, current volume, shares outstanding, option short, and the importance of country. Firstly, the IPO date stands for the initial public offering date. This is when a company decides to go public, selling a specific amount of shares to the public for the first time. This date can often be a reference point for evaluating a company's growth and performance over time. Next, the industry refers to the specific sector in which a company operates. This categorization allows investors to compare similar companies within the same industry, providing a broader perspective of a company's competitive landscape. Thirdly, analyst recommendations are evaluations made by financial analysts about whether a particular stock should be bought, held, or sold. These recommendations can influence investors' decisions, but it's always important to do your own research. Now let's talk about current volume. This represents the number of shares that are traded during a given period. High volume often indicates strong investor interest and can lead to significant price movement. Shares outstanding are the total number of shares a company has issued. This number is used in many key financial metrics, including the calculation of market capitalization and earnings per share. Options and shorts are advanced trading strategies. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell a stock at a specific price on or before a certain date. Shorting, on the other hand, is betting that a stock's price will fall. Both tactics involve higher risk and potentially higher reward. Lastly, the importance of the country cannot be understated. The country of a company's domicile can impact its business operations and stock performance. It's crucial to consider factors such as local economic conditions, political stability, and regulatory environment. These terms add another layer of understanding to our stock market knowledge. Ever noticed how the market moves up and down? Let's understand why. There's a symphony of factors that come into play when we talk about market movements. One of the key drivers is the earnings base. Remember, a company's profits are a crucial indicator of its health and future growth prospects. Higher earnings often lead to an upward swing in the market. Then we have the price-to-earnings ratio, or PE ratio. This measures the price you pay for each dollar of a company's earnings. A high PE ratio could mean the stock is overpriced, or that investors are expecting high growth rates in the future. Expected growth is another factor. It's the anticipated increase in a company's earnings. If a company's expected growth is high, it could lead to a rise in its stock price. The discount rate is the interest rate used in discounted cash flow analysis to determine the present value of future cash flows. A higher discount rate reduces the present value of future cash flows, indicating a higher level of risk. Technical factors are the statistical analysis of market activities such as price and volume. These help traders and investors identify market trends and make better decisions. Price history, the record of a security's prices over a period, can also influence the market. Past performance, while not a guarantee of future results, can provide insights into potential trends. Exogenous events like unexpected news or global events can have a dramatic impact. These can trigger sudden and significant market swings. The macroeconomic environment, such as inflation, unemployment rates, and economic growth, can influence investor sentiment and market trends. Current market trends, market sentiment, investor psychology, news and rumors, even supply and demand, all play their parts in the grand dance of the stock market. Remember, the stock market is an interplay of these factors. No precise equation can predict its movements, but understanding these forces can certainly help navigate the complex world of stock markets. So, we've covered a lot of ground today. Let's quickly recap. We began our journey by unraveling the complex world of stock markets. We discovered that understanding this intricate ecosystem is a key to successful investing, but it's not a simple task. It demands a thorough understanding of various terms and measures that act as signposts guiding our way. We then dove into a sea of key terms. We explored the meanings and importance of terms like exchanges, market cap, earnings date, price, index, dividend yield, and many others. We found that each term holds a unique piece of information, a clue that helps us make sense of the stock market's complex puzzle. Next, we ventured into the territory of advanced terms and measures such as PE, price cash, EPS growth, return on assets, LT debt equity, payout ratio, and more. These measures, we learned, are vital tools for evaluating a company's financial health and predicting its future performance. And then, we looked at the factors that cause the market to move up and down. We examined how earnings base, PE ratio, expected growth, discount rate, technical factors, and a host of other variables can influence market dynamics. We realized that market movements are not random, but an interplay of these factors. In essence, the stock market is a complex entity, where a multitude of factors interact and influence each other. The terms and measures we discussed today are like a map that helps us navigate this complex terrain. The more we understand these terms and the factors that influence market movements, the better equipped we are to make informed decisions. So keep exploring, keep learning. The journey of understanding the stock market is a marathon, not a sprint. It's a journey of continuous learning, where every step you take deepens your understanding and brings you closer to your financial goals. Knowledge is power. The more you understand these terms and factors, the better you can navigate the complex world of stock markets. Stay tuned for more such insights, and remember to like, share, and subscribe for more such informative content. Before we wrap up, we have a small request. We've spent countless hours researching, script writing, and producing this content to make the complex world of stock markets a little more accessible. If you found value in this video, we ask that you show your appreciation by hitting that like button. It's a simple action on your part, but it means the world to us. It's like a virtual high five, telling us that we've done a good job and encouraging us to create more of such content. And while you're at it, please consider subscribing to our channel. Subscribing allows us to reach more people like you, who are passionate about finance and eager to learn. It helps us continue to unravel the complexities of finance one video at a time. Your likes and subscriptions keep these videos coming. Thank you for your support and see you in the next video.